Hi everyone, my name is Paul Tilley and welcome back to EC 1210 Macroeconomics. Today we're looking at Unit 5, which deals with aggregate expenditures. But before we really get to that, let's do a little review of where we are now that we're 5 units in. First of all, we have to understand that macroeconomics is a study of the big picture. It's the economy as a whole, okay? And since we've started this, we've said, okay, let's look at the big picture of macroeconomics. And in Unit 1 and 2, we did exactly that. Effectively, government and the Bank of Canada are responsible for macroeconomic policy in Canada. And the reason we do that is to make sure everyone has a job. Ultimately, government has to measure the health of the economy to ensure that it's working well. And when it's working well, people have jobs, money is flowing, people can buy things, and the economy is healthy. So ultimately, that's the purpose behind the study of macroeconomics. In the second unit, we introduced the concept of national income and how national income is created. And in that, we introduced a very important concept in economics. And that very important concept is called the circular flow model. And effectively, the circular flow model demonstrates how money goes around in the economy. And what we do is we basically, in order to understand the theory of it, the theory says, look, there's two basic groups in the economy. There's firms, business, and there are households, okay? So the firms are the companies, the organizations, the groups that put things together that we as households buy. Farmers, factories, these sorts of things. The households are made up of people like us. And we buy those products from the firms, but we also supply the labor and the skills, and oftentimes we invest in those firms, okay? So what happens is that there is a flow between the firms and the households, and the flow moves in two directions. First of all, if we look at the flow of money, okay, that's the first thing we have to find. The flow of money, households buy products from firms. So we move our money to the firms. In return, they send us the products. Okay? Now, firms, on the other hand, buy labor and money and these sorts of things from us. They hire us. We are the skilled labor or the professionals that go and make the firm do what it does. So again, the money flows to us in the form of wages that we in turn can use to buy the products firms make. So this is this circle of goodness, or virtuous circle that exists within our society. We also introduced the concepts of inflows and leakages to this system. The system is fairly closed, meaning that the money flows between government and households and back to firms. The system is fairly closed in the sense that there's a sum of money that flows between households and firms and firms and households. So this you could see this constantly moving back and forth as we earn money, we buy products and services from firms. So this is globally looking at it from a point of view of, so this is looking at it from a macro point of view now in terms of everybody in the economy is buying stuff and all the firms in the economy. We're not looking at one individual, we're not looking at one firm, we're looking at the group as a whole. We introduced too this concept of sometimes, for example, there are what are called leakages. And leakages just means that stuff in our economy gets money, for example, in our economy gets pulled out. And how does it get pulled out? Well, it gets pulled out because people save. When we think of people actually saving, for example, the savings takes money out of this circle. Or in the case of firms, we could see firms not investing, and that takes money out of the economy. Government, too, would also take money out of the economy in one respect through taxes. Taxes, for example, will pull money out of this circle. Or investment by government could put money into this circle. So again, this circle is key to what we're looking at within the economy. So it's very important that you understand circular flow. Over the remaining units, we're looking at the various issues that are impacting the circular flow. what's causing money not to flow, what's slowing down the economy, what's speeding up the economy, what's causing leakages, what's causing injections. Unit 3 in particular looked at two of the big key ones that we're all familiar with, and that is the impacts of unemployment and the impacts of inflation. Unemployment, as you're probably aware, deals with the issue of people not having jobs. And when they don't have jobs, they're not productive in the economy, so they're not really contributing to the incomes and flows, and their ability to purchase is reduced. Under high inflation, we lose our spending power. In other words, a dollar doesn't buy as much tomorrow as it buys today. So as a result, our ability to spend or to buy things is reduced if our spending power doesn't go up accordingly. So inflation can have a significant impact on the flow of products and services to the household. And from a household point of view, the households are going to be looking for more money. In other words, we're going to be looking for higher wages and higher benefits because inflation is eating away at our buying ability. In Unit 4, we discussed the impact of aggregate supply and aggregate demand. Aggregate supply is the total of all the products and services supplied in the economy. Aggregate demand is the total of all the demand, so you, me, and everyone else buying stuff in the economy. We saw here that variations in the amount of products supplied, or amount of services supplied, or variations in the amount of demand, the stuff that I buy and you buy, can have a significant impact on the economy. And we talked about the concept of gross domestic product, which is the sum value of all the products and services produced in an economy in a year. We talked about the concept of the business cycle, how the economy goes up and down naturally, and government's job is really to ensure that those cycles aren't too wild. And we talked about economic growth and how we try to get economic growth in order to increase the total sum of products, services, and money flowing in the economy. So now today, let's take a look at Unit 5. Unit 5 is called Aggregate Expenditures. And aggregate expenditures is the sum total of all of the expenditures that people like you, people like me, businesses, government, you name it, all the spending that goes on in the economy. Now, aggregate expenditures is a very important part of the circular flow because it is the amount of money that's put into the economy. And we know, based on the circular flow, that more expenditure means more money into the economy, more people, more money going in terms of wages, more people buying things, these sorts of things. Less money tends to reduce the amount of money in the economy, which tends to slow down the economy. This measure that we use in terms of the amount of money in the economy, amount of product that's being produced, is known as the gross domestic product, or GDP. And the idea is that we want a good, solid GDP, not so big that it generates inflation. We talked about inflation in the previous unit, but big enough so that we have sufficient growth to ensure the economy is moving forward. Let's take a look at some of the key issues here. First of all, this is Unit 5, and you'll find the information and the material covered in Chapter 6 of the textbook. We are going to, in this particular unit, look at some key terms in here. We're going to look at this concept of expenditures from two perspectives. We're going to look at what's called autonomous spending, and we're going to look at what's called induced spending. We'll explain that in a bit. We're going to understand the concept of expenditure equilibrium and how the economy always moves towards equilibrium. We're going to explain what factors can affect spending and how that can affect our income. We're going to describe how small changes in spending have a large impact on national income. And we're going to see the significance of what's called the Keynesian revolution. John Maynard Keynes was a famous economist who studied this, and ultimately he helped get us out of the Great Depression with his theories. In terms of aggregate expenditures, then macroeconomics has really a broad focus, looking at the economy as a whole. And we need to think about circular flow and how that money flows around in the economy. It is a virtuous loop. As we get more products made, means that we can buy more products. We get more jobs because those products are being made. That means we have more income, these sorts of things, as the economy improves. As the economy slows down, less jobs, less money spending, less products bought, it creates a negative atmosphere. So what are some of the key elements? Well, in this unit, we're really focusing on spending or expenditure, and we're going to look at it from the point of view of several different kinds of spending, okay? First of all, and the one that's nearest and dearest to us is consumer spending. You and me, what we buy. And we're going to look at what are some of the determinants of consumer spending and what impacts that. And we're breaking it really into two components. We're going to break it into consumer spending that we have to spend, which is called autonomous spending. We have to, for example, pay rent or pay our mortgage. That's spending that's going to happen regardless if things are good or if things are bad. And we're also talking about another type of spending called induced spending. Induced spending really is related to your income. The more your income, the more you're going to spend. The lower your income, the less you're going to spend. So these are more or less optional spending issues that we deal with in terms of induced spending. The second major element that we're going to look at is investment spending. This is what companies and people put their savings into in terms of making an investment, building, buying, investing in the economy, these sorts of things. So companies, if they feel things are going to be positive, will tend to increase their investment spending, and people will do the same. If things are looking not so good, they tend to decrease their investment spending. We're also going to look at a third element called government spending. Government is a big player in the economy. If government spends a lot of money on buying ships, buying airplanes, buying military goods, buying any number of things, then government is injecting a lot of money into the economy, and that's going to speed up or enrich the economy and speed things up. If government slows things down by spending less, that's going to slow things down in the economy, and that's going to impact us. And finally, we're going to look at this concept of net exports. Net exports, the reason it's called net exports is, we have imports, which is stuff coming into the economy, and we have exports, which is stuff going out of the economy into the big wide world. What we try to do is to simplify it by looking at what's called net exports. So we look at how much we import, how much we export, look at the difference between the two of them, and hopefully we export more than we buy, so we'll have a positive net exports. And positive net exports helps bring money into the economy, whereas a negative net exports takes money out of the economy. So in terms of a mathematical, we use this terminology AE for aggregate expenditures, and it's made up of these four elements I just described: consumer, investment, government, and then exports. The first thing we want to look at is this idea of the distinction between autonomous and induced expenditures and what impact it has. Well, if we look at household expenditures tend to be made up of stuff we have to buy and stuff we buy. So stuff we have to buy, such as our rent and food, we're going to buy it regardless if our incomes are high or low. We still need, we might pay less if we can, but your rent doesn't change in the economy. If the economy is good or the economy bad, your rent is still there. Now you could say it goes up, but let's assume that rent stays the same. You're still going to pay rent. You're still going to have to buy groceries. This is autonomous spending. Induced spending, if you suddenly get a good job that pays lots of money, you're probably going to go out to dinner more or buy more steak, less hamburger. That's induced spending. And when we think about spending, our total spending is made up of the combination of the two. The induced spending plus the autonomous spending would give us our total spending. And we can look at this as a proportion of our income, and we'll call this the marginal propensity to consume, which is really looking at how much of a change in consumption happens when our income goes up, or how much of a change in consumption happens if our income goes down. And it's just creating this relationship to say, what impact does a change in our income really have on our spending ability? We also have something called a marginal propensity to save, which is our savings, how much we save if our income goes up. And really we're looking at what degree our savings go up versus what degree our income goes up. Now, those two are related because we have a stock of money, a pile of money that comes in. Let's assume you're making, $20,000 a year. You can only spend it or save it. So if you do more spending, you're going to have less savings. If you're going to have more savings, you're going to do less spending. So the combination of the marginal propensity to consume plus the marginal propensity to save will always equal 1. In other words, 2 of it totals your total income. Looking at our expenditures, we also need to think about what is expenditure equilibrium? And when we think about, we say, well, our basic choice is to spend or save. And we know about our marginal propensity to consume, which is really how much money we spend of our income. And the savings then would be the difference between what we don't spend effectively and our income. And this would be, as I mentioned earlier when we talked about the circular flow, this is what is called a leakage in the economy. Taxes, too, have an impact on how much money we can spend. If government increases our taxes, that means we'll have less money to spend. So if we think about what's called the marginal tax rate, which is the proportion of our income that gets pulled away or as we make more money, that's going to have an impact on how much money we can spend. That money we can spend is known as our disposable income. So as we discussed, our income is split into spending and saving. We save some, that draws money out. Income goes into the economy, and producers will produce enough products for us to buy with that level of income. When those two are equal, this is known as expenditure equilibrium. Of all the things that are produced or sold, there is no excess material, and that means that there is no necessary investment required by businesses to hold that inventory. So in an event where not all the products that are produced are sold because people decide to save more and spend less, there will be something called unplanned investment. And that means that companies will have to finance that inventory over its life until it's sold. This unplanned investment is really a function of the amount of product that is built up. More product means more unplanned investment. Ideally, the economy will come to an equilibrium where the amount of product produced is the same as the amount of product sold. In the third learning objective, we explain what factors can affect consumer spending and government spending and firm spending and how that can affect income. First of all, we talk about changes in autonomous spending. And remember, autonomous spending is stuff that we spend regardless of our income. But you think about it, if our wealth goes up, we make more money, we win the lottery, these sorts of things, we're probably going to buy more expensive stuff. Bigger house, more expensive car, these sorts of things. This is really defined as what's called the wealth effect, the effect of the change in wealth on consumption spending. We're just simply going to buy more. Changes in the price level is going to have an effect on us too, because if prices go up and we got to buy groceries, those groceries are going to suck more out of our total wallet. In other words, we're either not going to be able to buy as much groceries, or we're going to have to borrow, or these sorts of things in order to be able to make up the difference. Changes in the ages of consumer durables. If your car is wearing out because it's old, you're probably going to have to buy a new car. However, if you got a brand new car, you may not need to buy one for a while. And changes in consumers' expectations has a big impact. If you expect the economy to do better in the future, you're going to be much more willing to spend. How about a change in investment? What causes that? Well, interest rates is going to be a big player in companies' minds with regards to investment, and yours too. You say, okay, interest rates are really low. I'm much more apt to spend money on products and services and invest in things like new buildings, new cars, new homes, these sorts of things. Interest rate go up, suddenly we put the brakes on those sorts of things. The purchase price is going to have a big impact on investment. Price of lumber's gone up now, it's hard to go out and build a house. Installation, maintenance, and operating costs of capital goods are going to impact it too. The age of capital goods, no different than what we've seen. If our capital goods are wearing out, we have buildings that are old or machines that are old, eventually they're going to have to be replaced in order to be competitive. Business expectations as well. If we anticipate things to improve, we're going to spend money. And government regulations. Governments might dictate that, for example, that we need to buy an electric car if the gasoline automobile is banned. So even though we might have a perfectly good gasoline automobile, we'll end up buying an electric one. What about changes to government spending? What impacts can that have? Well, tax revenues are going to have a big impact. If government doesn't bring in as much tax money, it's not going to be able to spend as much. If government brings in more tax money, it's going to be able to spend more. Interest rates, again, no different than the rest of us. Interest rates mean that it's more expensive to borrow, and it's less, higher interest rates means it's going to be more expensive to borrow, and that's going to have an impact on an ability of a government to spend money. Social and cultural standards. If society expects us to do certain things or doesn't want us to do certain things, or for example, pollution, we got to spend money to reduce pollution. Voters' expectations, again, a lot of this has to do with politics. If voters expect that the government will bring in a policy that of $10 a day daycare, that's going to impact spending. Budget philosophies. Different political parties will have different philosophies in terms of more government spending, less government spending, buying this, buying that, not buying this, not buying that. The amount of exports, too, is certainly going to affect the amount of spending that goes on. If, for example, if we're Canada and we're selling lots and lots of stuff abroad, it means we got lots of money coming into the economy, more money to spend. If our products suddenly get more expensive and they're less attractive to outside buyers, that's going to reduce. So what are some of the things? Well, comparative price levels. What's the cost coming out of Canada versus what the cost coming out of the United States? Exchange rates. What's the relative value of the currencies? And income levels abroad. If people got lots of money abroad, they're much more willing to spend. The fourth learning objective looks at small changes in spending and how it can have a big impact on national income. Here we're talking about something what economists call the multiplier effect. And you could think of the multiplier effect as a lever, where a change in spending will have, a given change in spending, will have a significant impact on how well the economy is doing. Here we introduce something called the marginal propensity to expend. And really, the marginal propensity to expend is the ratio of the change in expenditures as a result of a change in income. So your income goes up a little bit, that changes your expenditures, that's going to impact the economy. So in general, a $1 increase in autonomous spending will lead to more than a dollar increase in income. That is the concept of the multiplier. So if we think about the multiplier effect, what we're really talking about is the knock-on effect of a purchase at point zero. So let's assume, for example, the Canadian military goes and buys a bunch of new aircraft to fly the Prime Minister around. Okay, those new aircraft are going to create an expenditure by government. Let's say $100 million. Okay? Now, as those aircraft get built, they're going to be putting other manufacturers to work building seats, upholstery, coffee cups, you name it. Those things all get built. So the purchase of the aircraft itself creates a bunch of spending in other areas of the economy that ripple through. So basically, I bought something, so they had to buy something, and the people that built that had to buy something, and this creates what's called a multiplication of income. Why does the multiplier happen? Well, the proportion of injection of new spending will itself be spent creating income for other firms and other individuals. These firms and individuals also spend a portion of that income, which creates a further set of income. So again, this is a continuous looping that continues to create extra income in the economy. In the 1930s, we were in the middle of the Great Depression. And the Great Depression really meant that spending was very low, employment was very low, production was very low, and the economy effectively was in the toilet. Noted economist John Maynard Keynes saw the value in the multiplier effect in helping solve the issue of how to get out of the Great Depression. He suggested that if government were to spend money, for example, buy things, then that would create this multiplier where government spending would create jobs, that would create other jobs, that would create other jobs, that would create other jobs, that would effectively put life back into the economy and pull us out of the Great Depression. Keynes was right. His application of the multiplier theory managed to get Canada, the United States, Britain, and all first world countries who were suffering through the Great Depression, it managed to get spending up so that people went back to work and the economy basically started again. It literally primed the pump to get the economy rolling. So Keynesian economics really has become a big tool in the arsenal of government and their ability to manage the economy. Government knows that in good times, reduce spending, and that kind of helps slow down the economy. The multiplier effect works in reverse as well as it does forward. In bad times, government spends money in the economy, and this helps create jobs, which creates knock-on jobs, which creates more growth in the economy. So Keynesian economics has been held up as a big tool to help the economy and help governments manage the economy and increase growth and manage these depression or recessionary times that we occasionally hit. That's the key components of this chapter. Thank you for watching. I'll see you next one.